Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Today we are looking at 5 high quality dividend stocks that are down a lot this year despite being some of the strongest, most reliable businesses in the world. These are companies with wide moat, strong free cash flow and elite when it comes to return on invested capital, and of course they have a long history of rewarding shareholders. So the price has dropped a lot, but the fundamentals of these businesses I feel like are still absolutely amazing. So what I'm going to do is I'm going to share with you guys some of the things that you need to know, some of the reasons why I said they're undervalued. Well, some of them might be undervalued at this point in time, but they're down a lot. As you know, like you've seen over the last few weeks, the S&P 500 year to date, this is what it shows. This is where we are now. And as you can see, a lot of the companies that are normally the technology companies, healthcare have joined a lot, and any industrial companies that has anything to do with AI have also done really well. But there are companies that have not done well at all, and these are the ones that I want to focus on. And because remember, when something like this happens, before the rotation started, and if you can see now, just for example, if we just focus on just last week, you could see we have a lot more red in technology side of things and a lot more in here in the healthcare companies. Basically have done really well in comparison to the industrials, in comparison to technology sectors and so on. So it is really important to have a diversified portfolio, like I've said before many times, and that's exactly what we're going to do. So we're going to look at these 5 companies that have done okay. Some are in tech, some are consumer staples, some are consumer discretionary, and what we want to do is basically look at each one of these companies. But before we do all of that, if you can join us at the Patreon account, that will be really helpful. It genuinely helps the channel. Of course, if you haven't subscribed to the channel as well. First company we want to look at today is Home Depot. Home Depot is down this year due to a slowdown in home improvement spending and the higher interest rates and so on. And because if the interest rates is down, basically it's coming down, potentially that will help this company. They have a strong free cash flow, a long track record of paying a dividend, high return on invested capital, and one of the widest moats when it comes to housing side of things. They've got them and Lowe's, and there's not that many companies in that sector that are basically this big, if you like. Revenue side of things, as you can see here, last 5 years we're looking at about growth of 7 to 8% almost. The last 10 years we're looking at about 7%, which is quite nice. EBITDA is growing, EPS, net income, free cash flow. So if we look at the EPS, for example, 7% in the last 5 years, the last 10 years we're looking at about 12%. There's not that many companies that are growing this fast and this big, if you like. Free cash flow, as you can see here, it looks absolutely beautiful. Slight decline from last year, so 17.9, let's call it $18 billion, to right now about $16.3 billion, which is absolutely fine. There's nothing to worry about that. Okay, and in fact, if you can look at that 8% growth over the last 5 years is absolutely amazing. Dividend side of things, as you can see, that beautifully growing every single year. Last 5 years about 8%, 9%. Last 10 years we're looking at about 14%, which is quite nice to see. And return of capital, for example, which means the dividends plus the basically buying back their own shares, how much have they returned to investors? Last 10 years is not a lot, but the last 5 years is still in the negative. Now, but you can see the shares outstanding is declining, which is quite good, because that means every share of this company that you own now is worth more. From 2003 to right now where they are is actually they're buying back their own shares, which is quite nice to see. And sometimes you need to know basically if the company's dividend is actually safe before you invest. So that 2.6% is actually safe. They have a credit rating of A, which is basically strong. And the payout ratio for basically this company is only 61%, which is quite nice to see. They've increased this dividend for the last 16 years, and they pay $9.20 for every share of this company that you own. And now switching things to valuation side of things, we want to see whether is this company a buy right now or not. So historically, this company has been overvalued, but 2011 was the last time the company was undervalued, and then COVID happened and it came back down, and then since then it's been going up because everyone was locked away, people were renovating their houses and so on. Interest rate were very low, so a lot of those things did help, but right now it seems a little bit overvalued. So if we look at the performance against the S&P 500 over the last 10 years, since 2005. You can see it has outperformed the S&P 500. And right now, moving forward, if we use basically the normal multiple, which is basically that 22%, 22 PE, has been trading over the last whatever years, then you'll get about 18%. Okay, on top of your money. So if you invested 10,000, you get about 11,800 US dollars. Now, if we look at Seeking Alpha analysts, we've got 19 strong buys, 4 buys, 14 holds, and it's about 18% upside from where we are. If we look at Morningstar valuation, you can see $335 per share is where they think the price should be. It's 2 stars, which means it's still expensive, but the company, of course, it still has a wide moat. If you haven't done it already, don't forget to press that like button. It really helps the channel. Next one we're looking at today is Procter Gamble. This one, again, a dividend king. Revenue side of things has been heading in the right direction for quite some time. $84.2 billion of basically revenue side of things. EBITDA is heading the right direction. The net income, free cash flow. I love this. So last, basically over years, a slight decline from 16.5 to right now $14 billion, but $14 billion of free cash flow for this company is absolutely amazing. Free cash flow is the money that companies use to pay any debt that they have, to buy other companies if they want, to buy back their own shares, to pay in dividends and so on, to acquire, they can do a lot of things with that money, which is quite nice to see. And then when it comes to EPS, for example, last 5 years we've got about 6% growth. The last 10 years we're looking at about 10%, which is nice for this as a company this big to grow that much is actually quite good. And in terms of dividend side of things, this is where this company shines. Over the last 5 years, we're looking at about 6-something%. Last 10 years, about 5%. And on top of that, you've got, if we look at this, let's have a look now. So it's about 1% return and about 3% return. But that is consistent dividend. Sleep well at night. Some of these companies are very, sleep well at night sort of a business that's going to give you that return of, invested about that up to 5% or so on. But as you can see, shares are declining, which is quite nice as well. Now looking at here, as you can see, the dividend is very safe, 2.8% when it comes to that dividend yield, double A minus credit rating, which is good. Then you've got 60% payout ratio. The payout ratio is basically the amount of net income, so what percentage of their net income they're using to spend on paying that dividend, if you like. So again, we've seen that already. 69 years of increasing that dividend, which is absolutely crazy, and that's what you get for every share of this company that you own. Now if we look at the valuation side of things, if we look at historically where the company has been in terms of valuation, again, it was undervalued in 2009, then it came back again, and then because of COVID, what happened here? There we go, COVID. That it's been trading around the blue line more than anything else over the last whatever year, so that it hasn't actually reached that sort of that 15 PE sort of a thing. And if we look at the performance against the S&P 500 for over the last whatever years, slightly underperformed, but when it comes to dividend, that's where the company shines. And then forecast side of things, if we look at the normal multiple for this company, which is that 24, if you bought this stock right now, you'll be making your 10,000 will become 13,300, which is nice. And if you look at the what basically Wall Street is saying, 10 strong buys, 4 buys, 10 holds, if you like, about 12% upside from where we are, $169 per share. And finally, Seeking Alpha, white moat, and then we have $148 per share right now, slightly higher than that, so still under fair value territory. So we're going to switch things from now on. So we've done with the consumer staples, we've done with consumer discretionary. So now we're going to look at some of the companies in the technology sector. And the first one is Salesforce. So Salesforce is a company that I have in my portfolio right now. And as you can see here, when it comes to revenue side of things, is beautifully growing every single year since the company's based since 2005. So the last 20 years been growing that, which is really nice to see. In terms of the total performance obligations, is also heading the right direction. Let's have a look at free cash flow here. Let's look at net income. Everything you look at, especially if we look at free cash flow of last 5 years, 27%, last 10 years about 32%, which is really good. Now on top of that, if you look at the net income, it's heading the right direction, so especially last 2-3 years. EPS has been, of course, up and down, but the company has been profitable for quite some time now, and as you can see, there's a massive jump from $4.2 billion to per share to right now $6.36 if you like. Then they started paying dividends, so they haven't actually been paying this for a long time, so we'll just see how that goes. And if we look at return of capital, shouldn't be huge because in fact it is actually, because they have been buying back their own shares, but we're looking at just 2 years, so 53%, which is quite nice to see. Shares outstanding, of course, it has been diluted over the whatever years because the company was still growing, but the last 2 years they have been buying back their own shares. So 2023 they had closer to 100, whatever that is 997 million. Then it reduced to the 984 to right now 974 million, which is quite nice to see. Now in terms of dividends, they have a very small dividend. It is a safe credit rating side of things, so we got A+, which is quite strong. They are only spending about 15%, which is very low. That's what you'll get for every share of this company that you own. Now if we look at the valuation side of things, historically you can see the company has been flat whatever years in between those, that orange line and the blue line. The blue line is what Mr. Market likes to trade these companies, and the orange line is that 15 PE that we normally look for, but for this one is about 34. And because it's a high growth business, but right now look where it is. It's below that line, so that sort of tells us it seems undervalued at this point in time. We'll look at the forecast moving forward in a second, but last basically 10 years it has performed the S&P 500, so 22% total return. The dividend is very small, so I won't even count that. And then when we look at the forecast, this is where things get interested. So if you bought this stock right now using that 15 PE, which is not basically a fair value for this company, the normal multiples for this company has been 40 in the last 5 years. Even if you reduce that to 20, even if you do 24, 20 will give you about 30% return. 20, let's say, what is that, 24 will give you 55. But if you say, okay, basically I think the company should be going back to high multiples of 40, that your 10,000 will become 25,900, which is absolutely ridiculous. So I think the company should be around 20s, mid 20s, because if we look at the forecast, I think if we look at this will give us an idea. Okay, so this is expectation. The forward PE becomes about 20 or 17 and so on, so it is slightly lower than that, so I don't think it will be that 40 whatever that we've just seen. And if we look at the Morningstar valuation for this company, as you can see, 4 stars is straight away. That means it's undervalued. $325 per share is where they think the price should be. Right now it's about $225, so it's about $100 higher than it should be, about $100 higher than where it is right now. And it has a wide moat, so it's one of those companies where people talk about and say all sorts of things, but I genuinely think is a great company. Right, the next one is another one that we've been talking about it for quite some time. It is very similar to Salesforce, but it's not, of course, it's not the exact same business model. It's a high quality software giant that pulled back basically heavily this year. They have when it comes to the fundamentals, near perfect renewal rates, for example, extremely high gross margins, rapid free cash flow, and so on. And if you look at here, you could see the revenues been growing over the last whatever years, so 25% in the last 5 years, and then last 10 years we're looking at about 32%. EBITDA has also been growing, and the net income, the free cash flow, the EPS. So if we look at the free cash flow again, we're looking about that 30% in the last 5 years. 10 years we're looking at about 45%, which is absolutely huge if you think about. Again, when it comes to EPS, same thing. So basically slight decline this year from $8.42 to actually that's 2024, so this year let's see where they end up, $6.84. so there's a slight decline. They don't have any basically any dividends yet, but when you look at the buyback, they have been buying back their own shares, so for the 1 year it's about 29% return. So let's see where they end up. Now the next thing we're going to look at is the valuation side of things. So as you can see here, 32 strong and basically strong buys from these analysts, 9 buys, 3 holds, and 1 is basically strong sell. And if we look at it here, let's call it 42% upside from where we are, $101,154 per share, which is quite huge. And if we look at the fast graph, for example, for this company, similar thing again, you'll notice that it's been okay, and then all of a sudden it's gone up a little bit, then it's been in between that line, which is very interesting in comparison. It hasn't gone up basically higher than that, which for quite some time. And look at where it is right now. That's very interesting. So let's have a look at the performance against the S&P 500 over the last 10 years. Again, almost at 30%. The S&P 500 about 13%. So we're looking at since 2000 and 2012, sorry, and 2011, so off. And if we look at the forecast moving forward for this one, again, we're going to use the normal multiples for some of these companies. Right now, if you bought this stock, you will be, your 10,000 will become 25,000 US dollars. But if you use it slightly lower, but because that is 84 PE, which is very high. And if we go lower than that, if we even go for the lowest out of all of them, which is basically that 42, you will still be making about almost to 2,500 by the time we get to 2027. So it seems it's undervalued at this point in time. And if we look at this Morningstar valuation, it's just over 1,000 US dollars. Right now it is about 800 US dollars, 4 stars. So that means it is undervalued. So another one that has a wide moat as well. So like I said, very interesting companies, all of the ones that we talked about today. The next one we're going to talk about today is Accenture. Accenture is one of the companies that have been sort of on my radar for quite some time. Free cash flow yield of almost 7%. That's very interesting. Revenue side of things, again, this is one of the companies in the when it comes to the consulting side of things. So they are the companies that are supposed to help a lot. So when AI came around, the company was doing well because they've realized all of a sudden every company out there will now need to upgrade their IT system. So they've got some sort of AI, right? And this is the right company to go to. So the companies will go to this company, ask them about, this is what we want to do, this is how so this is what you could do in order to add AI into your sort of a daily workforce, whatever. And yeah, they're supposed to have made a lot of money, but then since then things have not worked out quick, the way they were thinking about. Because I remember watching a video about the CEO talking about how this trend of AI is supposed to help Accenture, but it didn't work out. But as you can see here, last 10 years, about 7% and almost 8% up when it comes to that revenue side of things. EBITDA is growing, the net income is growing, free cash flow is growing. And as you can see here, last 5 years, we're looking about almost 7%. 10 basically years, we're looking about 11%, which is good. And then EPS, more or less the same, so 9%, 10% almost in the last 5 to 10 years. Dividend side of things, they have been growing the dividend for quite some time now. And then if you look at return of capital to shareholders, the last 5 years about 10% and 8%. This is very high quality business, I'll be honest with you. And if we look at the Accenture side, basically dividend side of things, 2.6% right now, 92% of it safe. AA- when it comes to credit rating, very low payout ratio, and then when you put 20 years of increase in that dividend, $6.50 something is what you'll get. Valuation side of things, if we look at historically where the company has been, again another one that's been in between these two lines, but since 2018 it's gone up, and then 2020 when COVID happened it came back down. Since then it's been going to the moon, and then now it's sort of a back again, but it's not that orange. So this is the expectation to so the growth expected from this company, which is that 7%, 9%, 8% for the next couple of years. So now if we look at the performance against the S&P 500 in the last 10 years, you could see it has outperformed the S&P 500. If we look at the forecast moving forward for this one, and if we use the current whatever PE that company has, that 15 PE, you'll actually make some money. You'll make about 400 by the time we get to 2028, if that was basically if we were using that 15 PE. But if you use the normal multiple for this one, which has been that 28, 29 PE, you will be making you will be almost doubling your money. Even if you use 20, you'll still be making about almost 4,000 US dollars. If you use that 17, you'll still be making about closer to $2,000. So it is really cheap and is interesting because this is the type of companies I really like adding to the portfolio. And as you can see, we've got 12 strong buys, 2 buys, 11 holds, and 1 sell or strong sell, 10% upside from where we are. And again, it looks like another one that's fair valued. So 252 is where it's at right now. 267 is where basically it should be. So it seems is undervalued. So very high quality business and undervalued at this point in time. There is quite a lot. So despite the market, being up so much year to date. So if we look at, for example, a year to date, you'll see green everywhere, but there are opportunities. The companies that we talked about now, are here. So you've got the Salesforce, you've got the Adobes, we've got Now, for example, ServiceNow. Accenture is another one that's down 28% since we basically whatever. The companies that we talked about today, Procter Gamble, which is down about 10%. Home Depot, we talked about it, is down about 12%. So every single one of these companies is down a lot, and there are opportunities out there despite the market looking very expensive. And this is the time to look at your portfolio and basically sort of rebalance it. If you've got, in my opinion, I'm going to do some rebalancing, inshallah. I'll share with you guys and when we do the portfolio update. But it is important to sometimes rebalance your portfolios. I'm not saying go away and do that right now, but it is important to look at your portfolio, and sometimes you just need to trim things if they've gone too far, and then maybe just buy those companies that you think in the long run will do well for your portfolios and so on. So yeah, these are amazing companies, that generating strong free cash flows and so on. They have a long history of rewarding shareholders. They, durable competitive advantage. They are still growing revenue and cash flows and so on. And right now they're down because of the macro situation, and their businesses are doing really well. So let's see how it goes. But that's what I wanted to share with you guys. If you are enjoying this content, so like the video, subscribe to the channel. Don't forget to join us to the Patreon account. If you own any of the companies that we talked about today, put it on the comment section. Let me know what you think. Are you holding it? Are you buying more? What was your opinion? How long have you had it? Just share it with the community, inshallah. Have a wonderful day. Assalamu Alaikum.